So it's time to start, Alex?
Yeah, let's go.
Okay. So you want to start or shall I proceed?
I mean, I suggest you proceed and I will quickly then add the admin stuff and then we hand over to Paul.
Okay, let's do like that then. So I'm so happy to have Paul Hiebert here as an expert and special guest. He studied in Canada at McGill University, and then he worked for various important institutions, including the government of Canada, the IMF, and since many years at the ECB, who is holding the head of the systemic risk and the financial institution division. So thank you very much for sharing your insight with us. And maybe before starting, Alex, you want to say anything?
Yeah, just a couple of administrative things also. Hello from my side. So this is the last talk of this webinar week. And as always, we have the Q&A feature at the bottom or the top of your screen, whichever device you're using. And Paul is taking questions for clarification already during his talk. And then in the end, we are going to have about 10 or 15 minutes for a general discussion. So make sure to post your questions in the using this Q&A feature. And a second point would be we are trying to publish all these recordings over the next week. And if Paul agrees, we will also publish his recording as a part of this lecture series. And with that, I would hand over to Paul and looking forward to your talk.
Great. Thanks, Alex. And thanks, Angelo, for the invitation to speak at this lecture series. I guess it's always hard to be Friday afternoon because that's possibly when people are feeling a bit fatigued. But I hope it'll keep you entertained. And I think climate is no question. It is a very lively topic at the moment. And I think it's captured the attention, certainly of policymakers around the world, not to mention academics increasingly, and also the financial sector. So it's become a topic which went really from the doldrums. I think post-Paris Agreement, it was relatively quiet in financial fields, and now it's become very, very much central to our thinking and the work we do. And notably, I think the traction has been greatest here in systemic risk, and that's what I plan to talk about today. Systemic risk is an obvious one. If you think about the properties of a prospective climate shock, it does have the sort of the feel, the taste of something which could be quite systemic, insofar as it has the element of being potentially quite broad and pervasive across industries, across sectors. In that sense, it can be quite disruptive. I guess the difficulty with climate, and this is really where we're seeing it in terms of the take-up, it's basically the idea that it's quite a long horizon issue. And I think that's fundamentally why it's hard to tackle. But we'll get into some areas in this presentation, which is ostensibly, as the title would suggest, financial stability and climate risk, about a narrow financial stability angle. But I think it has a more pervasive and broad view to it. And it really draws from a report of the European Systemic Risk Board. For those of you familiar with the ESRB, it's tasked to look at systemic risk in the broader European Union, which formerly was 28 countries, now 27. And we worked together to have a report called Positively Green, measuring the risk to financial stability. And the reason we had this positively there is climate, as you see in the US elections or anywhere it's discussed, tends to have a lot of normative, strong views. Our intention here was to leverage information we have here within a central banking and supervisory committee, which tends to be very quantitative, a lot of granular data sets, and to use this for the purpose of mapping to what we can actually see with climate. And you'll see there are gaps as I go into this. But what we want to do is establish what can we measure with information we have, models we have, the literature we currently see already, and where are the gaps and how can those gaps be filled? Because arguably, when you're thinking about policy, which is our endpoint in any institution like the ECB, the European Systemic Risk Board, the SSM, or supervisors, whether it's prudential, whether it's central banking, it's going to be what you can measure, you can manage. And as long as we can't measure this, it's going to be very hard for us to devise policies which are well informed and let's say, empirically grounded and analytically based, which is ultimately what we want. So with this in mind, we took exactly those three things I mentioned. The policy and academic literature, which is burgeoning, existing data, now both proprietary in the form of financial sector's exposures. We have a very good view on these types of data post-crisis. We've had a lot of reporting to us, very, very granular. But also the data which is increasingly being reported by firms for all its warts. take stock of that and apply available systemic risk methods to these questions. And when I say available, you'll see why I mentioned the word available. We do need more investment if we're going to make them suitable for climate. But I'll come to that at the end. So really the way I'm going to structure the talk today is as follows. I want to talk about effectively climate in 4 blocks. And the first is really, we are not generally climate scientists here at the ECB or in any of the other bodies I mentioned. We tend to be economic or financial professionals. So we need, nevertheless, when we start looking at climate questions, to understand what climate scientists are telling us. And that is generally through the Network for Greening the Financial System. I gather some of you might be somewhat familiar with this. It's the concept of post-Paris Agreement, before the standard-setting bodies came to the table, the Basel Committee on Banking Supervision, the Financial Stability Board. An early mover was a Network for Greening the Financial System, which was established by the Banque de France, Mark Carney at the Bank of England, the Netherlands Bank, Frank Elderson, who's become the chair, set up this body with a relatively lean number of members, 8 members, to look at questions for central banks and supervisors, which would be important. With time, that's burgeoned out to, I think, over 60 members now around the world. Notably not the US, but all other jurisdictions are pretty much in. And what they're doing is trying to lay the ground to try and translate between economics and finance, which we know well, and climate scientists' output. And that's really more and more about integrated assessment models, work that kind of had sat on the wayside with economics and not been so mainstream, and to try to bring climate closer to what we know. And so we're working a lot with them and the work they're leveraging with the Potsdam Institute and other in climate world to understand this first question: are climate shocks likely? Now, as I go, I'll ask the questions and I'll give you the preliminary answers in case you want to switch off and have a green tea at any stage during the seminar. You'll at least know the punchline. Here's the questions first. First, climate shocks. Second, the question is going to be about financial market pricing of these shocks. I'm noting that financial markets are already starting to move a lot. You see BlackRock, other major firms, expanding their list of ETFs, or environmental social governance funds, green bond markets burgeoning. You'll see this in these slides. These things are occurring in parallel and probably suggest scope for what financial markets tend to do, overshoot. And third is going to be about financial institutions exposures, which again, we can measure quite well and quite granularly here. And lastly is to take this exposure-based analysis, so basically a mapping of who to whom, and move that a step further with some scenario analysis and ask, what if we were to put in some structural, based on what we have, again, existing models, scenarios we can already run, models, economic and financial flavor, but informed by climate questions. So just to answer these before I go through the rest of the presentation, because I think this is, again, just to give you a flavor of where I'm going to head. First question: are climate shocks likely? The answer will be, I'm going to be quite provocative here. Not only, yes, they're likely, I would even say they're inevitable. Some form of climate shocks will occur. The horizon is as yet more difficult to say, but the probability is very, very high. Second question: are financial markets then pricing these shocks? The answer is not really, or let's say not enough. And what that means is there is this scope for repricing once you have this sort of salient event, like we've seen with COVID, which was also a sort of unknown unknown or unknown known, got repriced into financial markets, financial assets, industrial probabilities of defaults, insolvency expectations. These things happen quite rapidly, and climate could be very, very similar to what happened with COVID. Maybe a different set of industries, but a very similar phenomenon. And in fact, there's been a lot more research on climate. One of them is about salience. So salience of a shock really does often determine how much financial markets price it. Are these shocks that we've seen recently in our recent memory, or are they things which seem a little bit more distant or maybe not so obvious? And the salience of COVID has become obvious. Climate is probably one that's becoming more and more salient. So financial markets can often overshoot. We know this with the type of Dornbusch overshooting model for exchange rates. Similar things can happen for other assets like equities or bonds. The third question about are financial institutions exposed, you'll see that's where we can say a lot here in terms of proprietary information we own here vis-a-vis our confidential supervisory reporting. And the answer I would say here is going to be limited for euro area institutions, financial institutions like banks, and abating only mildly, but they are concentrated. And of course, I'm sure in your other lectures in systemic risk, one of the things you've surely taken away is weak tails of firms, weak parts in the system are where we should be paying most attention, because those can drag down the aggregate often. And the fourth question then is going to be about forward-looking scenario analysis. What can we do with taking this idea about exposures mapping and understanding the scope for repricing, translating that into a type of standard macro model we use, move that forward in terms of a forecast, of a baseline, and think about an adverse scenario where you have one of two things: climate adjustment through transition risk channels, as you'll see. I'll define these terms. Through a policy shock, we have a carbon tax, or you have rapid technological change. And the answer we'll give largely in this, again, I'm hinting at answers here at the beginning, will be that the likely costs are contained. They can be somewhat meaningful for some institutions, some sectors, some industries, some firms, but they're probably a lot less than what you'd see if you had to deal with climate risk, which is unabated entirely. So the scope for policy action, or the possibility of policy action could limit costs is quite high. Now that's enough talking for me about what I plan to do. Let me now launch into, I think, the bulk of the report, which is going to be about what we do. And I'll start with a couple of slides just for those of you who are not terribly familiar with climate. We'll probably look at this and think it looks quite nice. I've never seen this before. For those of you who know climate quite well or have been well versed in the topic, this is yesterday's news. This has been a very, very graphic denying what's happening with climate change. Recall in this first block, I want to talk about what's going on in climate itself before I turn to the economics and finance. And here it's about what has been happening with global temperatures, annual global temperatures since 1850. It's 150 years of global temperatures. We can get this in the UK Met Office. And you build out effectively in this nice painting style stripes, minimalistic. Every year, how many standard deviations are we away from that average over that 150 time frame? 2.6 gives us the 6 colors we have here. So that's 3 shades of blue, 3 shades of red. It's pretty obvious when you look at this chart what's been happening. Over the last, say, 2 decades or so, we've moved into what looks like a trend warming in global temperatures, and in some cases, very extreme warming. So 2.6 standard deviations, recall in your distributional statistics that 95% of observations fall within 2 standard deviations, 99, and a normal distribution should fall within 3. So we are now starting to get really into the tail of global temperatures. And if anything, that seems to be accelerating. This was up to 2018. And we can say that 2019, 2020 have been obviously very, very warm years. The next slide is going to give us not just about climate temperatures, but if you just want to do a pure correlation, you can be a climate enthusiast or skeptic. But I think you cannot deny that there's a close correlation between what I've shown you on temperatures at the global level and carbon emissions in the atmosphere. So global CO2 emissions have this sort of hockey stick shape. Again, for those of you familiar with climate, you'll say, I know all of this. For those of you not familiar with climate, hockey sticks is the other thing that's entered into our nomenclature after climate stripes and weather stripes, is this idea that you have global CO2 bumbling along since as long as we can measure. This is 800,000 years ago, which scientists are able to pull out from fossils and other records, and see that post-industrial revolution, we had a huge spike initially, which was slow moving, and now has become very fast moving into an almost vertical line. So CO2 emissions, and if I were to map this against temperatures, global temperatures, it's almost 1-to-1 correlated. So clearly we're moving away from what was global warming due to physical factors to global warming, which is due to anthropogenic factors. Human global warming seems quite likely. Now, with these preliminaries in mind, I think what is useful is to turn to what is the forward-looking view. So I've shown you already where we've stood in terms of recent years of global warming, recent years of CO2 emissions. What climate scientists in Potsdam Institute, other places have been doing, and this IPCC, the Intergovernmental Panel for Climate Change, is to map out scenarios linking gigatons of CO2 emissions per annum, which is in the left-hand side of this chart I'm showing you now, and the potential warming that we'll see in the globe, which is the right-hand side. Most climate scientists talk about a 2-degree or 1.5-degree tipping point, whereby nonlinear dynamics set in. And nonlinear dynamics meaning polar ice caps melt, you have changes in ocean currents, you have changing temperature inversions occurring. All of these things start to contribute to an acceleration of dynamics, which probably mean that we start to enter in a lot less stable territory. It's a bit like when inflation rises to too high level, so too does the volatility. And with this in mind, what we've seen is that policies, as they're announced in the 2016 Paris Agreement, which the US just recently pulled out of, even if you were to adhere the targets that had been set there, we've already now locked in a 1.5 degree increase in global temperature. So we're very close to that 2 degree tipping point. And let me walk you through these scenarios, because I think it's quite interesting to see. The red shaded area on top of this slide is really going to be about the warming that we projected if nothing was done. No policies were taken. Policies presently in place, this is blue shading. Again, well above 2 degrees, as you can see here. If you had pledges and targets associated with the Paris Agreement, we'd be 2.7 degrees 3. And that's, again, optimistic policies are ones that are planned, not implemented, but pledges and targets, really, if we were to strictly adhere to those, we're still above 2 degrees. What we need, and this is why I think the misnomer is thinking that climate is something which is decades or even a century hence. If we're going to see the type of adjustment needed to bring global temperatures down to 1.5 degree compatible profile, or even 2 degrees, we need an adjustment in CO2 emissions, which is immediate. It starts next year, not 10 years hence, not 20 years hence, immediately, and it's sharp. And I think that's the main thing to take away from this. Now, what I wanted, again, feeling the idea that we had the notion I wanted to impart to you that there are costs and there are measurement, that is what I want to do in this study, is the cost would be of no action is quite high. Numbers around 1/4 of GDP has even been bandied about now recently by Mark Carney and Janet Yellen, former Fed chair, in an Oxford economics report, which I don't cite here. So by the end of the century, even 1/4 of global GDP could be wiped out. Here I've listed around $20 trillion, which is about 1/5 of GDP. These are enormous numbers. It's an enormous amount of destruction. But the next bullet I have up here is about, well, there's no free lunch. So if you were to invest and get on this trajectory of reducing CO2 emissions, you need to invest. You need to invest in climate efficient technologies. You need CO2 taxes, which will reduce, potentially temporarily at least, GDP growth. And these are not trivial either. So we're talking about 830 billion per annum, so around 1 trillion per annum, are huge numbers. So with this in mind, we have to think about cost of action, cost of inaction, and hence, when you get to the idea of physical risks, the idea of storms, floods, these sorts of elements, or ocean level rises, river level rises in Europe, these are acute and chronic physical risks, this red line, which could accompany anything above 2 degrees, whereas transition risks, anything getting below the 2 degrees, are going to be about the adjustment to avoid that outcome. And where I came with this conclusion I hinted to earlier, climate risk is not only likely but inevitable. You have one of the two of these are inevitable. They will pop up and need to price into assets. And a worst case scenario is when both come together, where you tighten too little, you've done too little earlier, and too late comes a tightening, and you compound physical and transition risk together. Now, what COVID has taught us, and I think this is an interesting byproduct of COVID, is you had during the lockdowns in spring, we saw a marked reduction in CO2 emissions. And that marked slowdown is here in the right-hand side chart, where we saw in April, you had around a 17% decline in CO2 emissions when China, Europe, and much of the rest of the world was completely locked down, shut down, factories stopped running. Now, if you translate that into an annual total, it's around 4 to 7% is what our estimate would be for the year as a whole, 2020, because of that April period. That is the type of slowdown we need a sustained basis to get us down to a 1.5 degree emission pathway. So again, I want to give you a flavor of what type of action is needed. It's a massive reduction. And keep in mind, these are not just theoretical about COVID. The European Commission is now operating the European Parliament on a target of around a 55% reduction of greenhouse gas emissions compared with 1990 levels, or even 60%. And that starts to move us into this territory. So we are, in a sense, in a way, in a world where you could have very, very strong climate shocks in the policy front. Now, when it comes to the overlap of COVID-strained and emission-intensive sectors, I think I'll just park it with this as an interesting point as a coda. A lot of money in the COVID environment, public money, has gone into propping up corporate earnings during this most difficult lockdown phases. And interestingly, there's been quite some money put into firms like electricity and gas, or heat, transportation like cars, manufacturing and construction, which tend to be very much greenhouse gas emitting sectors. So if public money has gone into firms which are private, you can imagine that there might be some pressure, public pressure, to ensure that these 55 to 60% emissions targets of the EU and greenhouse gas emissions, maybe that this is one vehicle. So this is a very real potential source of shocks. So the next question I want to ask, and this now starts getting into more familiar economic and financial space as we move along, is given that we have these likely climate shocks, even inevitable climate shocks, are financial markets pricing these? Are they taking into account that these could occur relatively soon and be relatively sharp? And this is what I want to touch to next. Now, before we get to financial market pricing, as such, it may be interesting talking about what could constitute reasons why financial markets don't price. Again, as part of your lecture series, surely with in St. Gallen, you've surely touched upon the idea of market failures being one of the sources of potential inefficiencies in pricing. And this is clearly one example. So we can all argue whether the allocation markets in terms of allocative tendencies they would have are the right ones between sectors, between industries, between firms, in moving capital to the places which effectively need it most without an externality, a pecuniary externality associated with some sort of public good like climate CO2 emissions causing us to all have difficulties. But I think apart from these allocative inefficiencies, probably the more fundamental question is, are there informational inefficiencies which prevent us from going there? So Martin Helvig, I really like a lot up in Bonn, and he had a very interesting AER publication, I think it was from 1984, he pulled out once in one of his lectures, suggesting that when you give markets the right information, they're extraordinarily efficient, but they're inefficient informationally, certainly. Allocatively is an open question. And he talked about the orange futures market. It was a very interesting paper where the orange futures market in Florida in the 80s, the people who were working in markets in the futures and in the options market were pricing orange futures such that they were predicting weather patterns, so not current weather, but barometer, coming weather, better than the meteorologists. So in fact, the informational efficiency with which markets were processing through pricing signals and the like, were a better predictor of weather than meteorologists using fundamental data, which is pretty impressive. His point was that didn't mean that you had crop problems with oranges, and not at all. So allocative efficiency is not guaranteed by informational efficiency, but is probably at least a sine qua non, and you need the informational element to be handled before markets can allocate well. And this is this slide. What we see is if you take environmental social governance scoring, which has become more and more popular in investors' portfolios, particularly this year, what you see is that if you take two different firms that are actually producing these rated asset buckets, and that is Refinitiv Icon, which is Thomson Reuters, and Bloomberg, so two leading market providers, actually go through ESG, so go through firms, and based on a series of issues with firms, the measurable elements, pecuniary elements, they actually can then come up with a score rating of ESG. What we'd expect is if there's a complete alignment of these environmental social governance ESG scores and the bucketing of these assets, that the corporates which are actually disclosing it, these portfolios which are disclosing ESG scores, should have basically a 45-degree line. They should agree completely. What we're finding is they don't agree completely. And in fact, it looks pretty much like a cloud, and that cloud is a steepening line through time. So 2009, I'm looking at the left-hand side chart now, that the blue line is a relatively flat, it's just a pure cloud. The yellow line, 2015, starts to steepen, the red line starts to steepen a bit more, but it's certainly far away from a 45-degree line, suggesting that markets are having a difficult time with the consistency of their allocation to ESG buckets, i.e., markets are not necessarily pricing, go back one, in a consistent way. And so that's going to be three messages I want to pass on here. And that's in the top line italics you'll see in this slide. And there's three problems with current reporting which are preventing markets from, again, being informationally efficient and therefore allocatively efficient. And that's that they're incomplete disclosures of firms. There are voluntary standards for firms to tell us what carbon emissions they have. And these voluntary emissions standards, something which is devised in Basel by Mike Bloomberg and company, historically, which is called the Task Force on Financial Disclosures. It's been around for a while, and it clarifies what sorts of disclosures are needed from firms, but it's not binding. And what we're finding is that firms self-select. And you know what happens when you self-select is you might not necessarily get a true view on the population of emitting firms. And that means the incompleteness, it's very hard to infer data where data doesn't exist. And this is a problem for markets. Secondly is this point about inconsistency, which is this cloud I'm showing you here. Once they're actually piling to this information, they're not assigning the buckets in a way which is consistent across different providers. And the third thing is they're insufficient. What do I mean by insufficient here? So there's different scopes of carbon emissions. And to make this maybe tractable, think of a diesel car versus an electric car. So a Tesla versus, say, Volkswagen. Scope 1 emissions would be what are the CO2 emissions at production of that car in a VW factory or a Tesla factory. Scope 2 emissions are more or less about indirect sort of inputs. What is the actual emission intensity of those inputs that you're providing to that car? Scope 3 is downstream, and that's the important one. What happens when you actually drive that car? When you take it off the lot, it's out of the production assembly line, and it's emitting greenhouse gas emissions into the atmosphere. Probably most importantly, Scope 3 tends to be reported patchily or not at all by most firms. In fact, mainly not at all. Meaning we have a bit of a problem. If I'm to measure VW versus Tesla, I'll actually find Tesla, in most cases, will be more emitting as a firm, because at production it is more emitting, whereas that electric car is probably less emitting, much less emitting in its lifetime. So it gives us some problems of insufficiency that markets also have difficulty assessing this and pricing accordingly. Now, the next slide is going to get more into the details of getting away from the difficulties markets have to what we see in terms of market developments. How does that translate into pricing, actual pricing of CO2 efficient firms and CO2 inefficient firms? So what we've done here is we've taken the return on equity of firms who are relatively polluting. That is, they emit in the 87th or above, or 67th or above percentile of the firm universe we have of reporting firms. And then we have the relatively clean ones. They're below the 33rd percentile. What we see is this unconditional pricing would suggest it's not particularly easy to notice any discernible difference in return on equity of these firms. So in other words, the profitability of these firms is remarkably similar. What we've seen from the literature is that actually, interestingly, if you only look at the first moment of returns, you're not going to find too much, at least historically. And admittedly, I'm giving you now an unconditional picture. People like Lucia Alezzi and others at the JRC and ISPRA have been doing a lot more work on conditional pricing, conditioning it on firm characteristics, the relative liquidity, other things like this. You do see then some greeniums start to pop up. But if we don't condition much, we don't see much there. And what's interesting about this is, I think in the literature is two things. One is that greenium, you need to look for it, this premium for green firms. And it is probably small and growing, but it's still harder to detect. The second point, and maybe that's partly a function of the informational inefficiencies I showed you earlier. The second point is interesting is that the moments of the distribution, so the return itself, the median return, the average return, will give you one thing. The volatility, the skew, the kurtosis of that return, the higher order moments of the return distribution actually seem to be relevant from what we see in climate relevant studies. That is, values investors who go into ESG assets or green bonds or green assets tend to be much stickier investors. And therefore, when you're in particularly volatile periods, think of a Garch model where you have different volatility regimes. In the high vol regimes, you might see a lot more buying and selling of regular assets, but green assets tend to be more stable in a portfolio. And even in the case of large fat-tailed shocks, so skew and kurtosis. On the right-hand side chart, maybe one of the issues which is partly inherent to green bonds market. So we move away from equities and bonds, ESG, green bonds, and let's focus more on green bonds themselves. It's a market which is actively expanding in Europe. I'll get to that in the next slide. But just say one of the problems which may be difficult for investors is actually the time horizon. Recall, climate is a long horizon issue, and our own subjective discount rates can be very different, whether they're hyperbolic, or whether there's sort of standard discount rates, standard risk aversion parameter, differ for all of us. They certainly differ for the current US president versus others in the US. So in other words, you can have strong normative views. But what's interesting is if you don't have the financial means of even pricing the views, because you don't have the sufficient tenor of the bonds, which would be commensurate to the lifetime expectancy of losses over the holdings of the bonds, that's probably going to also limit or stunt to some extent their information content. And that's a right-hand side chart here, where you see that interestingly, you have 80% of green bonds have a maturity of less than 10 years. So if it's a decades-long phenomenon, that's not inherent to the tenor of the bonds which are being issued, the green bonds. And even more interesting here is if you look at the slide, you see that the private sector components, whether it's green or conventional, that the green bonds actually have even a shorter horizon than the conventional bonds. So green bonds tend to be predominantly this red and blue 20-year bucket is relatively small for green bonds. It's mainly this orange and green that is up to 10 years, which is by far dominant in the maturity profile of these bond structures. What's happening nonetheless, and I think this is where it's interesting, is we talk a lot about exponential with COVID, but exponential with green bond markets is also something you could certainly cite. If you look at the path of growth in green bond markets since just effectively 7 years ago here in European issuance, and what you see is that from basically nothing 7 years ago, we've expanded pretty much exponentially through 2019 and 2020. What would have happened absent COVID, hence the light coloring here, is issuance patterns were obviously stunted by some market closures. But we can still say that it's about 10 times more green bonds than there were in terms of what was happening even 5 years ago. What's interesting as well is you're getting a lot more new issuers into the mix, but that the amount, about 100 billion per annum of issuance, is not commensurate to what the European Commission estimates is needed over the coming decades to get green investments mobilized to what's on this 2 degrees or less profile that I had shown you earlier. And they estimate around 290 billion per annum is needed in issuance to get us there. And certainly at the moment, we're only looking at a fraction of that, 1/3 or so. On the rating issuer split, which I think another interesting point, is the broadening effectively to more private sector content is also meaning that we have more and more interesting potential investor base expansion. So the investors who are interested in these bonds could be increasing. And let me go to the next slide, which I think is a more interesting breakdown, which is by public or private. So what's going on with the split between what the official sector is issuing and the private sector? What we're seeing with time is that the private sector is becoming more and more dominant. That's a dotted line here, which is the share has gone from basically zero, was entirely green bonds from governments initially, up to around 1/2 of the total, so 50% in recent years are now becoming private. And with that comes some, I think, appealing features for the market. So it's no surprise you're seeing more investment funds, more insurance companies, pension funds, so long investors getting into this space because they're able to move across the maturities spectrum, but also the rating spectrum. So whereas it used to be predominantly AAA, public sector, we're seeing more private sectors, which is much more sort of broad coverage of the rating spectrum down to single A, triple B, which is just above investment grade, start to be options. And of course, the returns that those embed can be appealing to investors. So we're seeing both rapid growth in markets and a broadening of these markets of green bonds. And I think what's clear there is, as that occurs, as we have the supply side move with the prices being relatively, let's say, inelastic to what's going on in climate. With time, we might expect this overshooting to take place as you have supply catch up to demand, or even overtake at some stage. We're certainly not there yet. I mean, that's something we want to watch for and think about then as scope for the next block, which I want to go to, which is financial institutions exposures. So should there be a rapid repricing, how would that affect our banks, our insurance companies and the like? Before I move to this next block, I just want to double check, Alex, are there any things in tow that I should be aware of, or can I continue?
You can continue, Paul. No questions yet.
Okay, great. So I'm going to get into more familiar space, so maybe the questions will come in the second half. In familiar space, I mean things we tend to look at here in terms of financial and economic terms, less about this more exotic green terms. So one thing we do have here is really good access to granular banking data sets. It's been one of, I think, the byproducts of being supervisors and banking union, but also more generally as part of the regulatory drive to increase information after the global financial crisis. And a couple of the data sets that we have here, we've leveraged to look at these questions. And those data sets are large exposures reporting. So banks, since we've been supervisors in 2014, here at the ECB, have been obliged to disclose to us any exposures that they have in excess of 300 million to any given counterparty, or 10% of their equity capital. And what that means is we can actually use that information to get a really detailed who-to-whom network, and not a network which is estimated based on maximum entropy, whatever it is. It's really a physical mapping of these risks. And we can actually twin that up, and that's what we've done together with so-called securities holding statistics, which gives us a view on what are, for the largest banks in the area, their holdings of financial assets, ISIN by ISIN. So really very, very detailed holdings of financial assets, be the equities, bonds, or other assets. And with that together, we've basically mapped here at the ECB around 17 trillion of banking sector exposures in the euro area. Now, that is 17 trillion out of around 28 trillion. So it's about more than half of banking sector assets. But of course, many of those, I should say, go towards interbank market exposures, governments, the like. The fraction which are corporate are quite a bit smaller. And what we do is we take that information, which is saying around, if I recall correctly, around 5 to 10 trillion, starts to be more in the private sector sphere and around 5 trillion corporate. What we can do is we can pick up climate reporting data, and that's publicly available through Thomson Reuters is one source, Bloomberg. Pick your third-party provider, give us information on what are firms emitting. And what we can do is we can match up the firms we have in terms of exposure side with the emitting firms and build a pretty detailed who-to-whom network, which, if I recall correctly, was around 2 trillion of euro assets of banks, which are mapped quite granularly. And I'm going to go through these data next, I think, and this is, I think, really an interesting part of our study. Is something that's not able to be done outside of these walls with confidential information. And that's around 1,000 credit institutions are covered by this, and around 8,000 corporates. So roughly, actually, around 5 trillion of exposures towards global corporates were here. Now, we had to make some interpolation based on missing reporting. I mentioned that was a bit of a problem. I can come around to that at Q&A if you like. But what I can say is that around 30% of firms were actually reporting, and we had to interpolate the other 70% based on industry averages. So what you'll see in the next slide does involve some interpolation, but it's based on, I think, fairly informed judgment. And what we're able to do with this granular data, now this starts to be the interesting questions we can ask here, is we can start to say, rather than where I think in sometimes the academic sector gets a bit stuck, is that what's publicly available tends to be in industry level data. But industry level tends to be a very crude metric that you bundle together firms which are quite different. And what I want to show you with this interesting heat map chart, I think, is really, really interesting. And this is a sort of box whiskers plot. So in other words, a distribution giving us the sort of usual moments of the distribution in the percentiles we'd expect, I believe, to the 90th percentile, which is the end of that spectrum. And you build into there the 33rd to 67th percentile in the green to red part. What we're seeing here is you can move across the firms in terms of those exposures and list their carbon intensity, their emissions intensity. And what we can see is the usual suspects are at the top here. So electricity, gas, steam, mining, quarrying, manufacturing tend to be areas where you see more emissions than, say, you'd have at the bottom of this chart, like education, arts, entertainment, recreation, where there's not much happening in terms of emissions. What's, I think, more interesting than this broad takeaway at the industry level is more at the firm level. And I think that's where the magic of the granular data comes through. Look at the dispersion in a place like manufacturing, information and communication, even electricity, gas, and steam at the top. It's enormous. So in other words, you can have effectively the capacity for companies to manage and conduct their business in a very emissions-friendly way or a very emissions-intensive way for more or less the same types of activities, which would suggest there's a scope for those firms to become far more efficient. And what that means is, of course, there's a scope for the pricing to be very discriminatory should that occur. And I'll come to that in a minute. So for those of you familiar with sectoral analysis here, we're really down to 2-digit NACE. So we're not at 1-digit manufacturing, which I'm showing you here, but we can actually dig into our data with much more granular data. And it'll be in the rest of the slides, I'll be using that sort of granularity to our advantage. Now, I told you I'm going to talk about banks' exposures. What we've seen is that banks' exposures tend to be declining through time, but only mildly. And initially what we're finding, Could you just give me 1 minute? I have my blinds going up automatically at the office, which is making it quite bright. Just a sec.
Sure.
Very good. Sorry about that. The smart office arrangement sometimes creates some of these issues. So we have effectively here the emissions of non-financial corporates. I'm listing them. We're in the left-hand side chart in these two left-hand panels. So you can think about that either in terms of the actual emissions in tons of CO2, which is this chart, or you could have it somehow relate to something which matters. It gives you an idea about for unit sales is what we're using here. You know, to at least gauge for size, because it's not particularly fair to say, well, large and small firms should be treated equally. So we have is, if you take it either unadjusted, which is just the overall amount of emissions for firms that we see in terms of non-financial corporates, which are in European banks exposures, what we see is that they're declining quite rapidly. They've almost halved over the last, say, 3 years. We had 2014 to 17, which is the latest we had at the time of the published report. Or in sales, maybe a bit less. We're still seeing this come down. But I think what's more interesting is to look at this part of the panel, banks' exposures. So what's interesting in the part of banks is that they seem to be having falling exposures more proportionately to high polluters than low polluters. So in other words, either actively or passively, because of this reduction here, banks' exposures seem to be falling particularly for the large polluter, the high polluter segment of the firm distribution. So banks do seem to be slowly reducing their emissions. And this seems to be at the right-hand side chart if we look across banks, so not just the aggregate of euro area banks, but think about banks themselves and look at the exposure, 2017 exposure, here's the size of the bubble, and whether they're carbonizing or decarbonizing over the period is a function of whether they're above or below the 45-degree line here. And most of them seem to be decarbonizing. So it's pretty widely spread across banks in the euro area. Now here comes, I think, the most interesting part of our exposure-based analysis is this couple of sensitivity analyses we run. I think this is one of the highlights of this report, truly. It's this idea that you have a simulated distribution of banking sector losses. So let's take a standard Merton model, which translates effectively the prospect of ratings changes into probabilities of defaults. And those probabilities of default, then you can translate into potential firm losses, in the case here, banks. So bank losses, if we were to take a very, and this is probably an inconceivably strong scenario, and I wouldn't even suggest that this is anywhere close to reality, but just by way of a thought experiment is quite an interesting one, is to ask if you took these energy intensive sectors, these climate sensitive sectors, I should actually call them, sorry. And by the way, the annex of these slides, you'll have what constitutes the types of industries in these sectors. I can mention energy intensive, predominantly manufacturing, fossil fuel companies, transport companies, thinking about air, thinking about land, thinking about water transport, all areas which are high emissions area. And consider the climate scientists don't just talk about carbon emissions, they talk about equivalent, carbon equivalent. So even things like nitrous oxide generally get translated back into what are equivalent carbon emissions. In transport, of course, sea transport is one of those places where it's not just CO2 per se, but it's also other potential emissions, which are very, very climate intensive in terms of warming. Utilities and housing to some extent also, the idea about green housing, all contribute quite a bit, according to Battistone and co-authors in Zurich, to potential climate shocks in a very meaningful way. They're the most meaningful sectors. If those sectors saw a rating agency come in and downgrade the entire sector to say these sectors to me, one which is going to face a pricing shock, what would happen to banking sector losses? With a one-notch ratings downgrade, you see an enormous amount of banking sector losses. So even 60% of banking sector assets could be impacted. And you see the types of places where this could be resident in a one-notch downgrade, particularly the manufacturing sector, the blue, but also housing, and you have also here the transport and effectively the fossil fuel sector would be very, very hard hit. Now, again, and you could have 2-notch, 3-notch, 5 notches downgrade as a complete Armageddon scenario where these sectors become worthless. Now, do I think this is likely or going to happen? Absolutely not. But as a thought experiment, it's a question just to understand what is the sort of mechanics that could be at play, because I think the next scenario, which is a much finer grid we're going to run, can actually be informed by the same type of logic, but this time recalling back, I'd shown you a few slides ago, within sector heterogeneity. So within a given sector, firms are very emissions intensive or emissions efficient. Even within a sector, wouldn't rating agencies or the holders of the bonds or the instruments which have these firms inherent to them be more discriminatory, thinking that, yes, indeed, this one oil and gas producing firm tends to be more emissions intensive than its counterpart. I think the counterpart's going to be safer from a climate shock. Seems quite a plausible scenario. And in fact, if we were to run that through using the same technology, and you'll see in a footnote a bit about how we've done this. Again, we take this idea that you have this sensitivity parameter in a Merton model, this alpha, which is a 1-notch, 3-notch, 5-notch downgrade. And we're going to go through by sector now and pick out that you take the firms which are in the emissions intensive part of the distribution of a given sector, so within sector distribution, and shift those sensitive corporates in terms of emissions intensity into a lower rating bucket, but only those firms. So rating agencies tend to be relative in the way that they rate firms. And relative to a sector given average, you'd say, okay, these ones which are highest emitting are going to be downgraded. Seems quite plausible. In this scenario, a 1-notch downgrade would bring us to banking sector losses around 10% of their assets, which is still really meaningful. So the system-wide losses here could be quite large, even just a 1-notch downgrade for these firms. So banks, I think, need to be cognizant of the fact that their credit risk profiles can change a lot and quite rapidly based on this. Now, higher rating downgrades, you can get into much more severe areas. This course is about systemic risk. If you have system-wide losses and not just firm-specific or sector-specific, we would say 4 notches or more is when you get into really the very much system-wide. So it probably is going to be not so much a systemic shock, at least in this incarnation initially, but it could very much be one which has still meaningful losses. And obviously, when you start filtering these through in terms of who-to-whom networks and understanding scope for fire sales, common exposures, other amplifiers to move through the system, it could be ways of maybe amplifying some of these returns I'm showing you here, which are purely based on an accounting identity for now. So I've shown you everything so far in the last 15 minutes. I want to now turn to, this was mainly based on what we're seeing so far, backward looking, and to move into a forward looking scenario analysis. So what if I were to say,
Paul?
Yes.
Could we have a quick clarifying questions on the slide you just discussed? So the question is, can you get a rough estimate for losses as % of capital for 1-notch downgrade? So it's about the X scale here. So
yes. So admittedly, you can take, these are percentage of system losses of banking sector assets. So you can just translate this through the shock to total assets back to capital, of course, based on the amount of leverage in the system. Now, I don't think it's a one-to-one translation. I would caution against reading too much into this. As a likely scenario, again, we've made many assumptions on the reporting distribution of data here, and quite some assumptions about just a very agnostic scenario where we just take firms that are highest emitting, irrespective of the conditioning factors, and downgrade them quite blindly. So it is more illustrative, but yes, you could, in principle, you could take this and move it back to capital. And again, it could wipe out quite a bit of bank capital, but again, for those banks exposed to these specific firms in these specific sectors. And that's again where the concentration risk point I made earlier matters. So it may not be system-wide losses, but there could be some banks very much exposed. Hope that answers the question.
Thank you.
So let's move to the forward-looking analysis, because I'm conscious of the time, and I think I have about 13 minutes left, which should be good enough to cover this. And talk about effectively moving into a standard stress testing type of mentality we would normally have for thinking about bank capital. So the question has just been posed. We would tend to think of that as more sequence of a sort of capital planning horizon and try and move that into a more dynamic environment rather than a sort of static sensitivity analysis as I've just run. So again, I'm going to use similar data sources, but what I'm going to do is base this on a pilot exercise we had. Again, more details of everything I've shown you now are going to be in a report. I'll show you the link at the end in case you have more interest to read about it. But let me just tell you about what we've done in this scenario analysis quickly. So recall at the beginning I talked about physical risks, the risks of damages which come from drought, from storms, from sea level surges, river level surges. This stuff is physical risk we don't account for here. So we've basically started humbly, and I think in a way where we feel we have confidence, which is a shorter duration exercise. So this is 5 years, not 10, 20, 30 years. Hence, very hard to pick up in a physical risks component, and using a standard economic modeling framework, which I'll show you by the models in a second. And what that implies is we're very much focused more on transition risk. So the risk that carbon emissions govern some sort of potential shocks, which could, I'll detail again in the next slide, which are about the transition away from these potentially destabilizing climate disaster scenarios. And that's going to cover these two things in the slide here. There's policy actions, notably carbon tax, that could mitigate environmental change, or technological changes, again, over a 5-year horizon, rapid changes in either. And we're going to focus on bank losses which come from credit risk, market risk. We're not going to talk at all about operational or reputational risk, which arguably could be a big one when it comes to investors shifting preferences. And the way we're going to do this is very much a traditional stress test mentality we would do for any type of stress testing analysis here, which is we build up a scenario. In this case, it's going to be these two tail events. The delayed policy scenario, what we're calling here, is about a global carbon tax jacking that up to $100 a ton, which is enormous jacking up from single digit to double digit, low double digit levels in most European countries. And an asymmetric technological innovation, it's called here, which is basically about a doubling of the share of renewables per sector. So whereas everything I showed you in the slide, we're often at the firm level, industries. So it's industry level work, partly because you still have, Alex, it says my internet connection is unstable. Can you still hear me?
Oh, it's fine. It's fine.
Okay, great. So what it's going to be is an industry level shock. And that's partly because the economic feedbacks we feel we're more confident with at the industry level than to try and drill down into firm GDP, which would be very difficult. Now, what we're going to do is have that macroeconomic scenario, and it's going to be a familiar model for those in the policy world called NIGEM, the National Institute of Economics. National Institute in the UK has actually a model we've been using for years and years. It has quite a nice granularity associated with it, semi-structural model, and it allows us to do a lot with financial and macro variables. And what we're going to do is a couple of novel things. So, and that's what's green here with the parentheses. Compared to what we normally do in stress tests is exactly that: scenario narrative, a macro scenario run through, GDP, unemployment, standard metrics, and then you have effectively banking sector outputs. This time we have two nice innovations, and our Dutch central bank colleagues gave us the first, which is that they effectively did a couple of things: is translate back climate variables, which we're pretty bad at measuring as non-climate scientists here, into things we understand in economic production functions, economic models, i.e., an increase in the CO2 price would increase the prices of coal, oil, and gas. And these are inputs into many of the industries we're going to look at. An increase in the share of renewable energy could do two things. One is the fossil fuel intensity of the production function could decrease. So it's obviously a supply side shock. The other is about this idea of the depreciation rate and creative distraction. So the idea is you have these supply side flavored elements to a shock, and the top a demand side one. And it's largely, you can think about them as delayed policy scenario, demand side, asymmetric technological innovation, supply side shock, and aggregate demand, aggregate supply framework. The other nice innovation we have is we drill down into sectors in these 56 industries. And the way we do it is so-called embodied, these TVFs, transition vulnerability factors. And those are quite interesting the way we run this thing. It's largely a function of like CAPM style factor loadings. So you basically take a portfolio of these industries, you have the inputs which tend to be very different in their carbon intensity, and you effectively have a factor loading of a macro shock to that industry, which is a function of the emissions intensity of that given industry. So it allows you to differentiate the industries quite clearly. In the next slide, I'll give you a better feel for what I'm talking about here. So the sector level materiality, again, thinking of GDP, here there's a couple of financial shocks like 10-year bond yields or the equity markets. will effectively, again, in this demand supply scenario. So we're here about abrupt policy is this light blue. As you expect for a demand scenario, it's a bit more protracted in terms of GDP losses. When this is relative to baseline. And again, this is a very extreme scenario. Keep in mind, a carbon price of $100 per ton is enormous, or a doubling of the share of renewables per sector is enormous, and it's abrupt the way we've implemented these. To try and think about abrupt transition scenarios, what could be the sort of ceiling we might expect? The supply scenario is going to be a bit more neutral in the short term, small losses, and have gains in GDP as that technological innovation starts to feed through into production with some frictions out of the way. And it'll have obviously a counterpart in bond and equity prices. What's interesting, again, this factor loading thing I've been mentioning earlier means that it translates through into sector level risk very differently, whereby electricity, gas, and steam, dark red, have a large impact from these types of shocks. Whereas if you scroll down across the firms, some of the firms I was talking about earlier in the service sector have a very limited impact of these shocks. So in other words, we're able to do quite a nice thing, which is to have an industry level stress test rather than a standard sort of aggregate GDP and other aggregate macroeconomic variable impacts. I think the other main innovation we have here, which is quite nice, is we're able to twin together the Dutch central bank approach, which has done these two things, translate climate variables into macro ones that we can deal with in models and apply them at the industry level, and to use a state-of-the-art macro model which has a lot of feedbacks in terms of credit demand, credit supply dynamics, where you can have banks which have dynamic behavior do certain things like start to rescind and deleverage, rescind credit supply when they're faced with particularly strong economic shocks and the like. And that's a so-called beast model. And again, we're going to feed into that model, which is fanning out from what the Dutch have done for their banks into a more euro area relevant sample. So that's around 70% of banking sector assets in the euro area, and it's about 91 banks. So the biggest banks we certainly capture on for all 19 economies which share the euro as a common currency. And what we can do with that is again thinking about what are the standard channels here, from macroeconomic shocks to impacts on balance sheets, and this idea about feedback mechanisms. Deterioration occurs, they react as I described, excessive deleveraging triggers more adverse credit supply shocks, and you run this loop. What's interesting here is about these data sources, which are relatively novel for us. So securities holdings I mentioned at the beginning, large exposures data are being used in these different modules and these different parts of the loop. But also you have then these interesting elements that are related to climate, which are going to be about thinking about the industry resolution, feeding back as part of that mechanism with these CAPM style factor loadings. And what we then have in the results is the following, to the punchline. You have capital losses in the banking sector, which are around 0.8% per annum. And if you accumulate them, they're certainly less than what we'd see in a standard adverse scenario of a standard stress test, the type we run with the European Banking Authority here every 2 years. And those standard stress tests tend to have losses in excess of 3 percentage points from baseline of capital. And here we see much less, at least per annum, it's around 0.8 percentage points deviation from baseline, even in a very stark carbon tax increase would still cause GDP losses to be relatively contained. And interestingly, time-bound. So the peak loss would be potentially on a quarterly basis, the second quarter after imposition, and thereafter would start to abate mildly. And the lending which would accompany this to the non-financial private sector would also follow this sort of decaying profile in terms of intensity with time after impact. And what we see with the CET1 ratio in a supply side shock, so this technological shock, is even less pronounced. And you can take away many different things from this. I think that the main thing to take away from this, at least in our minds, is even if you are to have an abrupt transition whereby governments do extreme things with carbon taxation, that the technological shifts are extreme when it comes to averting carbon emissions as part of climate change, it's probably going to have really very much contained banking sector losses, contained credit supply shocks. And what that means is that if you compare that to the numbers I showed you at the beginning of this potentially 1/5 1/4 of global GDP wiped out from physical risks of climate change, because inaction early on implied we didn't get onto the path as a strongly path-dependent temperature evolution that would lead us to an aversion of these problems. We'll probably be looking at a situation where we're actually doing two things. We're being hit by climate shocks, and at the same time we're tightening policies, which would be a very much a double hit scenario we want to very much avoid. So timely action probably will get us away from this type of extreme reductions, because you could have a carbon taxation profile which is much more generous in time and effectively phased in versus this extreme one. But even in the extreme example, it's not yielding major losses of the type we'd see in a standard adverse scenario stress test. So I've been talking for the better part of 60 minutes. I want to just close up with some conclusions and some ways forward. I mentioned at the outset, we were keen to embark on learn what we can measure, but also have much more refined questions at the end of this exercise. It was a 1-year program we had so far, from June 2019 to June 2020, on what we don't know. And that's largely what I want to just close off with. So first thing on the climate shocks, I basically foreshadowed these 4 conclusions at the outset. I won't repeat them. But these are basically exactly what I told you at the outset: the inevitability, the financial market pricing, the exposures, and the idea that this contained cost relative to physical risk manifestation happen in forward-looking scenarios. But what I want to focus on in the remaining minute is just this idea about needs for further work. And I think 3 things are really have become apparent to us in running through what we can measure with what we actually have here as financial and economic types. One is we really lack the data we need to do this in a better way. And that is in 2 fields. One is we feel that the areas where data were deficient need to improve. Firm disclosures have to be better, they have to be more encompassing, and they have to be a bit more consistent. At the same time, physical risk, we've not measured anywhere in much of what I've shown here today, and that's something we need to tackle. If you want to have a very fair comparison between the costs of action on the side of carbon taxation or technological shifts versus the cost of physical risk manifesting itself in the form of destruction and damage to productive capital stock or other capital stock like housing, we need to have better data on the physical side, and this locational data in particular, geolocational. The second element after better data is about additional modeling. And here we're keen to work with this Network for Greening the Financial System and their consortium of integrated assessment model providers to better understand how you can integrate climate considerations into standard macroeconomic frameworks. Understanding that any model loses precision as you start to become more general. No one model can answer all questions. Reality is a complex place, particularly in long-bound, forward-looking scenarios that you're building that are decades long. At the same time, I think we feel we can still learn a bit more about the interaction of these terms. And that's, I think, where we move away from the standard macroeconomic modeling we had so far towards more climate-specialized modeling. And last but not least, it's about initiating policy reflections. What would we do once we measured all of this? And that's obviously still relatively uncharted. But an area of, would it be focusing on disclosures? Would it be focusing on additional potential quantitative requirements in banks? Would it be focusing on maybe new and novel tools we never tried and tested before that are specific to the question about protecting against risk of climate, which should be the safety and soundness mandate of prudential supervisors? So with this in mind, I listed a report link here. If you want to learn more, you're by all means welcome to go and have a look at it. I think I've tried to touch and scratch the surface of the report. It's a very detailed one. It was done with a lot of different national authorities, supranational entities that are part of the European Systemic Risk Board. And we're now involved in doing these things and these needs for further work as we speak. But for now, I park it here and then give it back to Alex and Angelo in case there are questions, comments, points of disagreement, points of agreement, whatever you like. All over to you. Thanks both.
Thank you, Paul, for this presentation. There are indeed a couple of questions, and since, as I understand, you have a tight limit at a quarter past, just for you to know, there are about 5 questions, so maybe you can keep the answers to about 1 minute, so that we can address all questions.
Good thing. I see some of them listed here. Autonomous attendee, Andrea. These ones you'll read out, yeah?
That's exactly it, yeah. So
okay.
It's even better if you can also have a look. So the first one is, what would be a differential for a greenium?
So is that about the relative magnitudes we're seeing tend to be in the single digits basis point territory to maybe low double digits. So it's not an enormous amount. And I think, again, Lucia Alessi and co-authors have done a lot in this field. Controlling for firm characteristics, controlling for other aspects for liquidity, which might be relevant. It gets into this very small basis points. So in effect, it's not enough, I think, to mobilize the type of climate investment we see as necessary to make financial markets endogenously get us onto a lower temperature profile. Good question.
Good. Second question. In case of another shock today, do you see a crowding in on green bonds vis-a-vis other bonds?
Yes, this is an important question. Thus far, the green bond universe, and I hadn't talked about that much in my slides, is a very small proportion of the bonds outstanding. So one of our board members, Isabel Schnabel, has spoke about this in one of her speeches recently. I think if I recall the number correctly, it's around 5% of outstanding bonds are green at most in terms of issuance patterns or new issuances. So it's still very, very much a small proportion. So we don't expect green bonds to meaningfully effectively come in and be a problem in terms of crowding out. What we do have, I guess, are a couple of concerns. So one is the so-called scope for greenwashing. I've not used that term in this seminar so far, but it's quite a common term in climate finance. And the problem with greenwashing is firms that say they're raising green funds, but it's not very clearly ring-fenced and allocated to green projects. So you could think of an extreme example where a firm that's doing oil fracking puts a windmill in one of its fracking cranes and claims that's a green investment. It's not inconceivable, and that would be clear greenwashing. Is not necessarily doing very environmentally friendly things, but has a windmill attached to it. So we have to be a bit cautious about that. And that's where the European Commission's been doing a lot of work. I'd say Europe's really at the forefront in regulating green, about accreditation of these green projects. For the moment, the scale is certainly not enough to cause a meaningful crowding out or a factor crowding in. And I think we're a bit concerned about the standardization of these green exposures so far.
Okay, Andrea asks, do your scenarios also account for the likely future impact on GDP due to the COVID pandemic?
So these were run before COVID. And it's relative to a given baseline. So you could think of it as, in a sense, as a linear sort of approach. So that you could maybe, it's somewhat additive in the modeling sphere, but of course in reality, not really. And I think what I tried to hint at the beginning is the sectors hit by COVID and sectors hit by climate are sometimes distinct, like the leisure sector, not necessarily so emissions intensive, but some of the sectors actually that are receiving public assistance are very emissions intensive and subject to likely shocks. So the amplification you could have through the interaction of these industry trends could be very big. So it's obviously something we have to take into account, and I think a worthwhile thing to reflect upon in our future work.
So what variables does a technological innovation shock consist of? Are we possibly simplifying the effects of this shock?
I just see, please move the window away from. Can you still see the slides? I hope, yeah. Okay, I've got a bit of an issue with the computing here. So here it is. The question again, sorry, was on which of these was here?
So what variables does a technological innovation shock consist of? Are we possibly simplifying the effects of this shock?
I see. Yeah, the technological innovation was purely the following. The share of renewables doubling means that the fossil fuel intensity declines. So recall a few slides back, I talked about the things we can do in NIGEM and its financial and economic modeling. We do, and it's quite crude. So just the fossil fuel intensity declines commensurate to what would be expected with a renewables increased share. So it is quite crude, and I think we could do that in a more sort of sophisticated way. Again, it's the nexus with climate and what we're doing here is going to have to be a bit strengthened. But for the time being, it was our first initial volley, yes.
Okay, then, if I understand correctly, the stress test used only large exposures. What do you think is the direction of the bias from this? What is your guess of banking if we included also small exposures?
Yeah, very good point. So the large exposures obviously is a bit biased towards large firms. A, and B, it's large banks. That's actually maybe even more important is the large banks. So concentrated banking systems like France with the 5 banks occupying most of banking sector assets, the 5 largest, are ones which tend to we see a lot of reporting from and large exposures. Whereas a country like Germany or Italy, where you have relatively, you have a lot of monetary and financial institutions, smaller, medium-sized ones, tend to fall below the reporting threshold. So first of all, at the country level, we're going to see probably less coverage through large exposures there. And secondly, some of the sectors which would be resident in these countries I mentioned might also fall under the reporting, out of the reporting purview. So let's take a German Mittelstand company, which is in the manufacturing sector, maybe producing a lot of emissions, will likely not have been reported because they'd fall into the large exposures threshold. Just to give you a direction of travel, one of the things we're doing now in extending this is ANA credit, so a new credit registry we have access to this year in a nascent form, should give us much more granular, so we have much more access to much more granular reporting down to an exposure of 25,000 euros. So with this, we can say a lot more about small exposures, and I think that'll be helpful to try and forward this work. But a very good question. There are limitations what large exposures tell us. And I think it skews it towards utilities and large firms which tend to be getting these big ticket loans from banks.
Okay, then last question, and this is a bit the big elephant in the room here. I also had this question. Tamaro asked, so green policies are not in the mandate of the ECB. Do you think the ECB should still implement them or consider them? And if yes, on which basis? What are the consequences in terms of systemic risk management?
Wow, with 2 minutes, you lobbed me with a big question, but I'll do my best, yeah? So look, our president and Isabel Schnabel have spoken a lot about this. I would say that that's a very good question, a very needed question. It's also maybe lacking a little bit of nuance. So is it part of our mandate? I mean, I'd insert a word in there. Is it part of our primary mandates? So price stability. And in a sec, or is it in what I've been showing you mainly in these slides is our secondary objectives. For other objectives of the European Union are still part of the ECB's mandate. It's not just the primary. So in effect, you have to think about the element of, we have these financial stability or other considerations to think about, sustainable employment, economic growth, the like, that are committed European objectives, but of course they're always subordinated to price stability. Now, I think the argument that we've been making here is that price stability itself could be affected through volatility shocks or other elements which could be important for inflation or growth. And you go back to Benoit Cœuré made a speech in the autumn of 2018 detailing this. And I suggest a read of that speech, because I think it's still very much the frontier of our thinking about how you consider that you could have climate enter into a primary mandate. In terms of the secondary mandate, financial stability and the like, yes, here I think is a clear case. You could argue the likelihood of large-tailed shocks, the likelihood of unsustainable economic growth developments and the like, could be things we'd have to think about in terms of our policy setting once we get past the primary side. I think on the implementation as part of the mandates, this is actually an active button you're pushing, because our strategy review at the moment, we're currently involved in, does have a climate leg, and it's looking exactly at this question. So what should be the role of climate in the ECB's mandate? What should be the role of climate in terms of the actions we take? And again, consider that, and I just want to close with this, there is a climate, there are two ways to think about climate policy. There's the risk dimension. Did climate cause risks to financial institutions, to the macroeconomic developments, whatever? And then there's the enabling policies. Do we think it's a good thing, a normative policy, that we should have more climate investment? Now, the political wing in Brussels will look at the latter, and they are looking at the latter. And I think that's warranted. They're the right entity to do that. And they're the right entity to implement policies geared towards these public objectives, these social objectives. We on the ECB side, and I think supervisory side is no different from safety and soundness of Prudential, is that we should be looking at risk. And here, I think, even from a narrower risk perspective, yes, that is part of our mandate. The question is, we have to clarify now in what respects and what should that imply? And that's very much what our strategy review is looking at the moment. So I hope that was a sufficiently non-evasive answer to a very live question at the moment.
Yes, thank you. So Angelo, maybe some concluding remarks.
Yeah, so maybe just a little point related to that. On the other end, if you think about unconventional monetary policies like QE and so, they are by very nature conservative in the sense that they follow, say, the capital key framework and so on. They tend to maintain the status quo, right? Continuing buying bonds and stuff. On the other hand, you know, the climate issue demands more an innovative approach, a new vision, right? So do you see any conflicting objectives between the two?
Yeah, so I think that, again, the most recent speech of Isabel Schnabel, I'd encourage you, if you haven't read it, all of your students to read it. It's a very interesting one. And she released, I think it was in July, she had one, and she also had one last month. And the point she made is the following. If we were, as you rightly point out, to have a more conservative approach and just basically take market pricing as given, we would have a market neutrality principle which would govern asset purchases, collateral policy, whatever monetary policies we run. And that would be such that we just basically bake in current market prices. If, on the other hand, from a risk perspective, we believe that market prices might embed some informational, allocative, or other failures, which leave them subject to repricing over a horizon that matters to us and matters for the economy and for our own implementation of our policies, we should be concerned about this. We might think more carefully about the principle of market neutrality as being the right principle to think about climate. So I'd probably defer to the speech because I think she does a much more elegant job than I do now. But it is a very valid question you ask. And Dirk Schoenmaker, for instance, and Rotterdam and others have been asking that question. Is market neutrality simply mean baking in potential mispricing, which could be subject to risk and should be of relevance to us in our own primary and secondary mandates?
Okay, thank you very much, Paul. That was a very insightful speech and lecture. Thank you very much. So I also want to thank everybody for joining the webinars during this week, and also Alex for supporting us in preparing this running. Thank you very much, everybody. Have a nice weekend. Bye-bye.
Thanks,
Angelo. Thanks, Alex. All the best.
Bye-bye.
Bye now.